And as the AI craze escalates across tech and beyond, a move yesterday may have highlighted a limit to the takeover and this sort of obsession that we have with all things AI. Shares of Zoom Communications fell by over 6% in yesterday's session, proving that the video platform's AI expansion wasn't enough to sway investors. That drop could be a signal that despite apparent AI hysteria, consumers need more to be convinced, and especially investors might need more to be convinced. Let's get back to Tony Crescenzi, PIMCO market strategist and portfolio manager. And this was something I wrote about in our morning brief today because it struck me that, we were doing all these counting of conference calls, right? And on Zoom's conference call, it was something like 80 times that the AI. Phrase AI was mentioned. Mm-hmm. And yet, investors still want to see a growth prognosis for a company. So right. How do you think people should be weighing all of this?
Well, for those who can think back this far to 1995, it was a so-called technology shock. So it reminds me of that. Lots of worry about what that new technology, such as the one we're being transmitted from right now. It was the advent of new technology that people thought would displace workers. But think last month, the U.S. jobs report.
It created jobs. It was better than expected.
Right, Diane. Yeah. 3.4% jobless rate, the lowest since 1968.
Right.
So even amid tremendous change over 20 years, we still have a low jobless rate here in the United States and in Japan, for example. So yes, in certain industries there'll be this creative destruction, but we'll more broadly probably have
And it does seem like each time we're in a cycle like that, there's this kind of scary part of the cycle where, yes, it causes jitters and you worry about the displacement within or disruption within your industry. And to your point, we were all like, what was it? We were heading into, was it Y2000? Was that what it was? Yes, Y2K, exactly. We thought all the computers were just going to shut down and everything. So that was the advent of a new age, the 90s. And, so we've experienced that transformation in AI, generative AI especially. But what does that, does it even matter to, financial markets in general? In the sense of let's say the bond market, does this generative AI matter in the bond market?
Yeah, it's hard to imagine. We're using it at PIMCO and others are simply for research and to gain insights, perhaps to do some writing, to have help with our writing. So it could create efficiencies, ChatGPT, that sort of thing. For the markets, I think the more information that an investor has in his or her hands, the better to make informed decisions. And I think AI will help bring that about. So perhaps it'll create efficiencies. But what it won't do is change liquidity in financial markets, because ultimately you have to have an intermediary. Right. It's called the principal agent model. And so it won't change that. It simply supply us with more information. To take it to the extreme in a different fashion, investors worry about the information flow they get from China on companies. There's not enough of it. So AI
or that it may be fuzzy.
Yeah, and it shows you that assets can become underpriced, and there's inefficiency in terms of raising capital because of that, because the price of capital then can be higher. So it could lower the cost of capital in the end, is what I'm trying to say, because investors can make informed decisions.
I want to broaden it out a little bit, because as we talk about these various parts of the market right now, I know that you are still bullish on the bond market sort of broadly, right? But drilling into that, I'm looking at some of the things that you favor: agency mortgage-backed securities, cash and short-term strategies, total return and income. And I'm just curious, as we sort of go through the rest of the year, given what we might see from the debt ceiling, from the Fed, et cetera, et cetera. So you don't think we're sort of at peak yields then, it sounds like, maybe?
Well, so the Memorial Day weekend is ahead, and one thing that a bond investor can get excited about, a nerdy thing, is 3 days of interest payments. And so these days they get excited looking at the interest payments hitting client accounts, my account, owning T-bills, whatever. And so yields might go up perhaps a little more, but we think they're likely peaking. So one quick view on this. The aggregation of bonds, treasuries, mortgages, corporates, according to the so-called Bloomberg aggregate, is about 4 5/8%. For credit securities, about 5 1/4%. With a little so-called alpha, this means that returns are likely to be 5-6% in high-quality assets, because starting yield is the major determinant of future returns. Now, importantly, that yield is up from 1% as a low. We think they're near the peak because of one simple factor. Last year, markets had a big miss on the forecast for the Fed and what it would do. They said 1%, forecasters, it was 5. This year, markets are saying 5 it won't be 9. Maybe it'll be a little higher. Probably not. We think the Fed's done. But the forecast misses plunge, and yields peaked last October. And there's stability in the bond market and return to correlation, as they say. When stock market falls, bonds rise. So we're expecting more of that.
So it's still a safe haven because there are no other havens.
And it's Tara, there are reasonable alternatives these days.
Okay.
Well,
Tina.
But I guess what you're saying too is that whereas yields may have peaked, they're not going to come down that much.
But the key is, though, and this is the history of it, is going back to 1978, 90% of the time, core bonds, meaning with an average maturity of, call it 6-7 years, high-quality bonds, have outperformed T-bills on a 3-year rolling return basis. So lately, of course, last year was a bad year for bonds and core assets. But just a few months before a recession, they tend to start outperforming, and 3 years later, you'll have this outperformance. And the average has been 3 percentage points. And so it looks like yields could decline. That's the thing you got to be thinking about. Get price gains that help you beat T-bills.
All right, we got to put a pin in our conversation. I love all the topics that we're going through here.
Thanks, Diane.
We appreciate you so much. Tony Crescenzi, PIMCO market strategist and portfolio manager. We appreciate you.